Driving a brand new SUV off the dealership lot is often the most expensive transaction of a person's life, and for millions, it marks the start of an 84-month commitment that will consume a significant portion of their future earnings. The modern commute is increasingly powered by people driving to jobs they may not even like, specifically to service the debt on vehicles they cannot actually afford, often to project a specific image to the world around them. This chart tracks the resulting macroeconomic pressure. Total American auto debt has climbed past $1.6 trillion, while repossession rates have begun a steady climb in tandem. These numbers are the logical output of a car-buying system that is structured to prioritize lender profit and interest accumulation over the buyer's long-term equity. We are going to look behind the sales tactics to see how dealerships use specific math to obscure the true cost of a car. And then we will look at the exact formula required to buy a vehicle without compromising your financial security. If you have financed a car recently, there is a strong possibility you are operating in a state of high financial fragility. Understanding how this trap functions is the first step toward regaining control of your income. The process usually begins in the finance office, where the focus is shifted away from the total price of the car and toward a single, manageable-sounding number. The salesperson will ask a seemingly helpful question: what monthly payment are you looking for? Answering this question allows the dealer to control the math. When you focus solely on a monthly budget, you lose sight of the total cost of the loan and the time required to pay it off. This diagram shows the primary lever they use. To keep a $500 payment while selling a more expensive vehicle, the dealer simply stretches the term, extending a standard 48-month loan out to 72 or 84 months. While the monthly payment remains comfortable, the total cost of the car surges. Over those extra years, you are paying thousands of dollars in additional interest for an asset that is losing value every day. The budget-friendly payment is a calculated distraction. It allows a buyer to overpay significantly for a vehicle that will be worth a fraction of its purchase price by the time the loan is finally cleared. The financial strain of a long-term loan is compounded by the physical reality of the car itself. This graph illustrates the standard path of automotive depreciation. Most new vehicles are rapidly depreciating liabilities that lose up to 20% of their market value the moment they are driven off the lot. When we overlay a long-term loan balance on this value curve, the problem becomes clear. Because the monthly payments are spread so thin, you pay down the debt slower than the car loses its worth. That red zone is negative equity. In financial terms, you are underwater. Being underwater means you owe the bank more than the car is worth. If your life circumstances change and you need to sell the vehicle, the sale price won't cover the loan. You would have to pay the bank out of your own savings just to stop owning the car. In the event of an accident where the car is totaled, the situation is even more precarious. Insurance only covers the car's current market value, leaving you responsible for the remaining balance on a loan for a vehicle that no longer exists. Using long-term debt to finance a rapidly depreciating asset is a mathematical certainty for the erosion of personal wealth. For those currently facing high car payments and negative equity, there are two primary paths toward recovery. The first is to prioritize the principal balance. By making extra payments toward the loan, you close the gap and get above water quickly. The second path involves selling the vehicle, absorbing the loss, and moving into a reliable used car purchased with cash. This stops the interest drain immediately and allows you to begin rebuilding your savings. To prevent this cycle, future purchases must follow the 20-4-10 rule. Put 20% down and finance for no more than 4 years to keep the loan below the car's value. Finally, total vehicle costs should never exceed 10% of your gross income. This math is objective. If a vehicle doesn't fit within these 3 parameters, it is a signal that the car is outside of your current means. A car is a tool for transportation, not an investment or a measure of your worth. Protecting your income and your future freedom requires prioritizing the money in your bank account over the image of the vehicle in your driveway.